and welcome back to yet another exciting week of the Lazy Money Game, the last episode for the year. So this is very natural for me to reflect upon what have I learned in my portfolio within this year, and also about how I am presenting my content to you. So hopefully you can learn as much as I am doing. So what I'm going to do in this episode is showing some of the reflections that I have for my portfolio, and then I'm also going to look into the statistics in Denmark to see how wealthy I am with this portfolio compared to different age groups in Denmark as well. And then finally I will answer a question which I have received from the audience. So let's start with a portfolio update. So the first thing we notice, as always, there's a green circle for this week's episode, meaning that the portfolio has increased in value. We go to the portfolio value tab, we can see that the value has increased by $400, and we can see that the cost is at the same level, meaning that I have not added anything into the portfolio. And it is also very clearly depicted over here by the cost function and the value function. That is one of the things which I'm really happy to have introduced, because now it's very easy for you to get an overview and see how much money I have actually inputted to the portfolio and what the value of the portfolio is currently. If we then continue to the dividends tab, then we can see that I have not received any dividends within this week. I knew that that was the case, and it's not too surprising. And I also know that I'm going to receive a little more dividends within next week, because I will receive a dividend from Bank of America and Suncor Energy. But I thought it was better to give a full overview and update for this year, since this is the last week's episode for this year. So what I really want to put an emphasis on here is the dividends that I have received year to date. I just crossed this $2,000 mark before Christmas. But what is really remarkable is that next year I'm going to receive more than $600 more. This is really where you can see the power of compounding, and that also very well aligns with the channel banner that I have: spend your time wisely, let your money do the heavy lifting. Because, as I have mentioned earlier this year, I have a plan of investing at least $1,000 every month, and if I have more, then I will invest more. So you can see this year my portfolio has actually contributed with 2 months of investing if I were to invest $1,000 every month. I know that that has not been the case this year, that I have actually invested more, but it's simply because I want to increase these numbers as fast as possible to really get this snowball rolling. If we then go back to the overview, then you can see that my portfolio is still down 9.18%, meaning that the portfolio is still down more than $9,000 year to date. But if you know when I have invested the majority of my money, I'm actually pretty happy with this result. And let me try and explain why. Because if we look at all the companies in the portfolio, then you can see there's some in green, there's some in red, and there's definitely some companies that are severely down. But this is the current view of the portfolio. Let me go back and show you how this picture looked in March. So this is how my portfolio looked back in March. I mean, look at this. Everything is severely in red. AbbVie, for instance, they are down more than 18%. Currently, they are up more than 20% in my portfolio. So the real lesson to learn here is, if you just invest in a company because I have invested in it, you would most likely have sold when you would be looking to your portfolio and this was what you were looking at. I mean, companies being down more than 70%. If you have just invested in a company because someone else has done it and you haven't done any research or haven't done your due diligence, the chances are that you would really have lost a severe amount of money here. But since I have done the research on my companies and I haven't really sold out of too many, I have sold 2 stocks this year in the portfolio, namely Delta Airlines and Disney. Otherwise I have kept all of them. And when you look at the portfolio value now, or rather when you look at the performance of the companies in the portfolio, then you can see that the picture has changed dramatically from what we were looking at back in March. So when we look to the portfolio today and see that it is still down more than 9%, I mean, no one will tell you that a negative growth of 9% is a good result for your portfolio, or if they are telling you that that is a good result, then there must be something wrong. And the reason why I'm not too disappointed myself in the performance of my portfolio is when I look to where I have been and the reasons for why I decided to invest a lot when I did, then I am actually not too disappointed, because I would expect it to take 3 to 5 years before I would actually be back in positive territory when I look to the last financial crisis that we had back in 2008. That is not the same as saying that I couldn't have done much better. Of course I could have done much better, but I didn't know. So I'm adjusting my expectations to the situation that I'm in. And that is what I think is really key to know. So for the same reason, when I see some of the companies in my portfolio dropping severely in value, that I just don't rush and sell them. Well, if I don't think that the fundamentals have changed, then I'm not selling. For instance, when I had Disney back in March, you could see that I was down around 25% on that stock, and I didn't sell it. I sold it when it was up more than 25%, around 9 months later. But that has nothing to do with that the stock is up or down. It has to do with the underlying fundamentals of the business, because when I see the price of the stock, but when I compare it to the fundamentals, in this case, for instance, the PE ratio, when that gets close to 90, then I really think that the stock is valued too aggressive for me to be holding in the portfolio. So I think it was severely overvalued, and then I will sell. And if I see companies in my portfolio dropping severely in value and I still believe in the underlying fundamentals of the business, then I would actually be quite happy and invest more, because then I will think that I get a bargain deal. The next thing I want to show is this press release from CEPOS, and it is about wealth in Denmark, and particularly they have made the statistics for different age groups, all the way from 18 years old and all the way up to 90, so you can see how wealthy you are compared to other people at your own age. And it is of course not surprising that the older you get, the more money you have up to a certain level. So for instance, if we go down through this table here, then we can see that the median wealth tops when people are 65. This is roughly the time where people start to retire. But if we go to the top 1% here, then we can see that it is actually when people are 72 years old that they have the most wealth for the richest part of the population. And we can see that there are huge gaps between how wealthy the wealthiest people are and how poor the poorest people are. And this is of course not surprising either. I will of course include a link in the description below, so you can go and check out this table for yourself. I know it is more interesting if you are a Dane, because then you can relate to these numbers much more than if you are living in a different country. And before we look closer at the numbers here, then I know that there are a lot of assumptions going into making a table like this. For instance, what type of wealth should be included, meaning do you own a house, do you own an apartment, should you subtract the loans that you have, do you own a car, and stuff like that. I'm not going to go in great detail into the assumptions about what they have assumed for making this table. I'm simply just going to present the numbers as they are. So if we for instance look at my portfolio, then you can see that I have around $91,000 in the portfolio, which is roughly translated into a little more than 550,000 Danish kroner. And if we were to look at this table and see where that put me in the median, then I would be somewhere between 39 years old and 40 years old to have the median wealth. On the other hand, you could say, well, I'm not even among the top 1% if I were only 18 years old. So as you can see here, there are really big differences. But for instance, if I were among the poorest 10% in the country, well, 550,000, that is actually more than some people ever gets in their life. So that is actually also one of the reasons for why I decided to start this channel. And I fully understand that if you are at the bottom 10% here, then I'm probably not presenting something which is interesting for you. But my guess would also be that you're not searching for this type of content anyways. So if you are at the top 50% or the median or the top 25%, then perhaps this is more interesting for you to watch, since you actually have some money that you can start investing. And by investing, I truly believe that we can increase the average wealth of every people in the country, or on other countries as well for that matter. If we then go to questions from the audience, then I have received a question from Luke that goes like this. Hey again, forgive me if you have covered this in a previous episode, but what do you pay for dividend withholding tax in your country? Here in Belgium it is 30%. Would you still recommend this strategy considering that? Over at the local investing subreddit, Belgium Fire, they heavily push accumulating ETFs because there is no tax on reinvested dividends nor capital gains. So first of all, thank you very much for the question, Luke. Highly appreciate that. And don't worry, if we have gone through some of the different taxations in Denmark, then it for sure can be revisited, because the Danish taxation is not an easy task to cover. So for the first one, the taxation rate in Denmark, if we go to the Danish skat, meaning our taxation webpage, then you can see here that if you have stocks, meaning aktier in Danish, and income on your stocks in 2020, we had a progression threshold of 55,300, which will be increased to 56,500 Danish kroner. And you can see that the progression tax rates are 27% and 42%, meaning everything that you earn below 50,300 in 2020, you will be taxed at 27%, and anything above you will be taxed by 42%. And next year they will increase the threshold from 55,300 to 56,500. And if we click on the question mark here, then it says that it is stock income from either dividends, foreign and domestic, and if you have gains or loss for buying or selling stocks as well, which are included in these progression limits. So that covered the first part of your question, since you now know the different thresholds in Denmark and the taxation rates. And hopefully it is also clear for you why I have an incentive to at least hit this threshold, since I quote unquote only have to pay 27% in tax for any stock income that I have below the threshold value. If we then go to the second part of your question, that you have a taxation rate of 30%, and if I would still recommend this strategy, well, since I have this progression limit, I have definitely incentivized myself to at least hit that. But if you have no progression limit, or if everything simply is taxed by 30%, and that you are not taxed for reinvesting or for capital gains if you are investing in accumulating funds, then you should have no incentive at all to invest in something that pays dividend instead of accumulating funds, because that means that you can avoid paying the tax, and that will make you accumulate your wealth faster. But whether or not that holds true in Belgium, I simply do not know enough to answer that question. But let me try to show you why I get to the conclusion that I do. So if I take your information for granted and simply say that is the facts, if we then have a dividend investing strategy here where we agree on a 30% taxation rate. If we then have 100,000 invested in 2020, then next year, instead of gaining 4,000 in dividends, then I would only gain 4,000 minus the tax rate of 30%. So I would gain 2,800 instead. And if you then accumulate that over a period of 10 years, then you can see after 10 years, I would have 131,000 on my account. But if we instead went with the accumulating investing strategy here, where there was no tax, whether or not that holds true truly relies on the assumption that you are correct in the question that you're asking, and I simply do not know enough of the Belgium taxation rates to comment on that. But based on the information that you have provided, this is how I view it. So you invest 100,000, you have a yearly return of 4%, and as you can see here, after 10 years, since you are not taxed every time that you are receiving a return, then of course your portfolio will increase much more in value, since we will now have $148,000 instead of $131,000. So hopefully this answered your questions, and you can clearly see why we have different incentives, since I have these threshold limits in my country, and why people in your country are pushing for this accumulating strategy, if indeed these taxation rules are as mentioned in your question. Otherwise, feel free to ask again if there's something here which is unclear. So that actually sums it up for yet another exciting week of the Lazy Money Game, and actually that sums it up for the entire year. So please let me know what content you thought was the best in 2020, so I have a chance to improve and do more of that in 2021. And if you like content like this, then please consider giving me a comment, leaving a like, or subscribing to the channel. It really helps me. And until I see you next Sunday, stay safe on New Year's Eve. Looking forward to see you in 2021. Bye!